The regular market session is currently closed, meaning we are analyzing the stock based on its latest figures. As of the close of regular trading on Monday, June 22, 2026, Supermicro Inc. closed at exactly $35.46 per share, representing a substantial intraday upward move of 15.66% on the day. While the broader financial community is obsessing over this single-day double-digit spike and attributing it entirely to a basic analyst upgrade, the real catalyst driving this sudden shift in momentum is something much larger that most casual observers are missing. The market narrative has been that this business was trapped in a margin death spiral, crushed by the weight of massive capital requirements just to build server racks. However, the unexpected development that just altered the equation is the company's newly announced deeply integrated data center rack solution built around Nvidia stock architectures, specifically leveraging the upcoming Vera Rubin platform. This specialized design integration means they are no longer just selling bulk commodity hardware with thin margins. They are shifting into fully managed, pre-configured infrastructure stacks that fetch a premium price. This move changes the entire financial profile of their massive backlog, creating a curiosity loop for investors who previously wrote off the company as a low-margin hardware assembler. The general market expectation for months has been that this business is a highly risky, diluted entity heading towards structural decline due to intense pressure from major enterprise rivals like Dell and Hewlett-Packard Enterprise. When you pull up an online investment portal or scan major investing sites, the consensus has leaned heavily towards caution. The reality, however, is that while retail investors were fleeing during the recent capital raise, massive institutional volume has silently begun rotating back into the equity. Over 121 million shares changed hands in the last session alone, which is nearly 2.5 times the 3-month average trading volume. This massive institutional interest shows that the smart capital is betting heavily on the underlying demand, realizing that a company sitting on a reported $39 billion order backlog cannot be ignored forever, despite its short-term growing pains. When you evaluate this company across an individual brokerage or through a comprehensive retail account, you quickly notice how wildly volatile the asset has been over the past year, swinging from a 52-week high of over $62 down to a low near $19. This dramatic volatility is why many self-investing enthusiasts using a standard trading platform have hesitated to build a concentrated position. If you use a modern robo-advisor or an intelligent portfolio, you likely see this stock excluded or heavily weighted down due to historical governance risks and accounting questions that have cast a long shadow over the corporate offices. The common perspective is that the business is simply too unstable to trust for a long-term online investing strategy, yet this discount is precisely what makes the current technical setup so compelling for aggressive traders who manage active investing accounts. Let us break down the massive recent trading movements and the structural factors driving the current tape. The massive drop that occurred earlier this year was largely triggered by a massive $7 billion equity and equity-linked capital raise that wrapped up earlier this month. Investors panicked, fearing that the massive dilution would wipe out per-share value. But look closely at why they raised that capital. They needed cash to buy expensive graphic processing units and high-end components to immediately fulfill billions of dollars in active, unfilled customer orders. Now that this financing package is closed and completely finalized, that massive overhang has vanished from the market tape. What was once a major risk has converted into a known, completed event, removing a significant layer of selling pressure that had been depressing the asset price for weeks. Furthermore, the operational metrics are showing a very specific technical bounce off the absolute bottom. In the fiscal third quarter of 2026, the company managed to pull its gross margins back up to nearly 10% after they had cratered to just over 6% in the preceding quarter. Management achieved this sequential improvement by deliberately moving away from selling raw, unconfigured computer chassis and moving directly towards complete, ready-to-run system solutions that bundle liquid cooling, power management, and proprietary networking software directly into the server racks. This change in product mix is inherently margin accretive, which completely contradicts the bear case claiming that intense industry competition would permanently force margins into the single digits. Please take a moment to comment below with how many shares of Supermicro you currently hold in your portfolio, or if you prefer to avoid this level of volatility altogether. To properly understand where the asset is going, we need to look at what the business actually does underneath all the market noise. Founded decades ago and headquartered in San Jose, California, the company specializes in high-performance, high-efficiency server solutions optimized for enterprise data centers, cloud computing, and massive-scale data processing.
Unlike standard computer assemblers, they build their platforms using a modular architecture, which allows them to bring new server designs to market much faster than traditional competitors. This operational agility is exactly why they became a core manufacturing partner for major semiconductor designers, allowing them to ride the coattails of massive enterprise data center expansions globally. Historically, the business functioned as a steady mid-tier player in the broader enterprise tech landscape, but the explosive rise in global computing demand shifted them directly into the spotlight. Their past performance highlights a company capable of doubling its revenue within compressed timeframes, as evidenced by their recent $10 billion quarterly revenue print. However, this blistering pace of expansion exposed severe internal bottlenecks, leading to delayed financial filings, internal accounting reviews, and intense regulatory scrutiny regarding hardware export compliance. These historical compliance issues created a permanent valuation discount relative to stabler peers, explaining why the equity trades at a remarkably low forward earnings multiple despite posting astronomical revenue growth rates. Looking out toward the future, the forward path for this company is entirely defined by the tension between market expectations and operational reality. In a bullish scenario, if the company can maintain its gross margin recovery toward the low teens as they exit the current calendar year, the stock is poised to compress its valuation gap against traditional hardware giants. The continuous rollout of next-generation server architectures will act as a major catalyst, especially as large-scale enterprises and specialized aerospace firms ramp up infrastructure spending to lease out massive computational blocks to software development firms. If these multi-billion-dollar backlogs successfully convert into clean, profitable revenue over the next few quarters, the equity could easily march back toward the consensus price targets set by major institutional research desks. Conversely, the downside risks remain highly apparent and should not be overlooked by anyone managing an active trading strategy. If the company reports a regression in its margins during its upcoming fiscal fourth quarter earnings release in August, or if the ongoing independent board-led investigation into their past accounting practices uncovers further structural governance flaws, the market will aggressively punish the stock. The broader hardware supply chain is also highly sensitive to component availability, meaning any delays in semiconductor shipping schedules would immediately freeze the company's assembly lines and choke off cash flow generation. In summary, the central insight to carry forward is that this business is currently operating at a sharp disconnect between its troubled public corporate narrative and its booming operational reality. While the general public remains highly fixated on past dilution, governance clouds, and historical volatility, the underlying corporate data reveals a massive manufacturing engine that is successfully turning a corner on margins and securing its place in the next wave of data center buildouts. The massive institutional accumulation seen in recent sessions suggests that the market is beginning to realize the risk-to-reward profile may have overcorrected to the downside. The tension between what the average investor expects and what the financial numbers actually demonstrate is creating a unique structural setup, ensuring that this company will remain one of the most heavily watched and fiercely debated names across the entire market landscape. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advisor. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Please don't forget to like, comment, and share this video to support the channel.